from the Wall Street Journal, ABC News, the Pew Foundation, shows that between approximately half and three-quarters of Americans no longer believe the American dream even exists. We are living in a golden age for investors. The most pessimistic people of all were young people. You want to own growth, yes, but all these people who are plowing everything into growth stocks and the Mag 7 and thinking that that's just the place to be and always will be the place to be are making a mistake.
Investors, welcome back to Masters of the Market. Now, I'm incredibly excited this week because we get to actually welcome back Mr. Alex Green, the Chief Investment Strategist over at the Oxford Club. So, Alex, welcome back to Masters of the Market. I knew you'd be back on here. We were just discussing before we jumped on here that it's been almost about a year, but since it's been some time, what exactly have you been up to?
Oh, a lot. Writing, traveling, speaking, doing all the things I usually do. But I'm really immersed right now in a book that I'm writing. It's called The American Dream, Why It Endures and How to Achieve It. And, you know, the funny thing is when you're working on a book, this will be my sixth, you're so into the book, it's hard to stop thinking about it. I mean, I wake up in the middle of the night and I'm thinking I should talk about this too. But the genesis of the book was last summer I was reading these polls. You may have seen them from the Wall Street Journal, ABC News, the Pew Foundation, that shows that between approximately half and three-quarters of Americans no longer believe the American dream even exists. And surprisingly, the most pessimistic people of all were young people. I don't know whether it's they think that the planet's going to be incinerated by global warming or the debt's going to drown us, or a lot of them are obsessed with inequality. I've learned because I'm trying to counter their arguments. But I'm into the book because I'm a great believer in the American dream. In fact, I make the case right at the beginning of the book that I believe that the United States is founded on three pillars. The first is the Declaration of Independence, which says that we are a free people with natural rights, the rights that precede government. The second is the U.S. Constitution, which is how we secure and protect those rights. And the third is the American dream, which is how we pursue happiness. And it's funny, as I travel around, I talk to Uber drivers and retail clerks and anybody else that I don't really know about whether they believe in the American dream or not. And some of the most astonishing people, some guy running a hot dog stand believes in the American dream, and some guy who's actually doing quite well and has 2 or 3 businesses doesn't believe in the American dream sometimes. But I'm trying to go about showing people why it's still alive, how it endures. And the people who are the most pessimistic, I've learned it's because they don't have the first clue how to get started. All they can see is their bills are mounting, their income is stagnating, costs are rising, and they can't see any way out of it. So what I do in the book is I start off by talking about why the American dream endures, the proof, the evidence that it still exists. And then I go about showing people, which starts with financial literacy, that you have to work, you have to live within your means and save and invest and compound. And then you will be able to have the money to live your dream. So that's really what I've been working on most intensively lately.
First of all, fascinating. Second of all, I want to ask you how you've been able to spin almost what is seemingly the worst part about building wealth, which is not spending and living a more frugal life. How did you spin that more of an optimistic direction, especially I feel like for the younger generation today that for really what it seems like we want to spend, we want to get out there, we want to live this luxurious life?
Well, you know, I look at like I used to be, Ari, a very heavy person. I had a 40-inch waist. I wore double XL shirts. My suits were custom made by Omar the tent maker, and I was a very heavy guy. And the crazy thing about it was I really wasn't really eating any differently than I had been when I was young and slim. But time and gravity tend to catch up with you. And just like you can't eat everything you want and still be as fit and as healthy as you'd like to be, so can you not spend everything you'd like to spend and at the same time become financially independent? Because the surprising thing, I think, for most people is people who are rich, most of them did not inherit their wealth. Most of them did not start their own companies. Even a lot of them don't have college degrees or graduate degrees. But what they have in common is they learned that, A, you do have to work. You have to live within your means and save regularly and invest smartly And of course, the real temptation, if you've gotten that far, which some people don't work, some people don't save, some people save but they don't invest. But what's sad is a lot of people, as the money grows, they go, oh my gosh, I can get that boat, I can upgrade the house, I can buy more bling or whatever, and they can't help but raid the treasury, and that also prevents them. That's the final step, is not touching it. But it's really a matter of, I follow the 50-30-20 rule. You spend 50% of your income on your needs, housing, insurance, utilities, etc., food and gasoline and whatnot. 30% on what you want, which is, eating out occasionally, not every night, and taking trips and having nicer things. And then 20%, I know it's just tough for some people, but if you save 20% or even 10%, but 20% gets you there a whole lot faster. And surprisingly, the young people have got the time on their side, in that if you compound your money over 20, 30, 40 years versus somebody who's 55 or 60 years old and goes, oh my gosh, I've got nothing saved for retirement, they really are sort of in a tough spot. But if you're young, there's time to change your goals, change your habits, and change your future by taking responsibility for your spending decisions, your saving decisions, your investing decisions, and ultimately you will have the financial freedom to do whatever to live where you want, be with whom you want, spend on what you want, and that's the reward. But it does, just like passing up that strawberry cheesecake in order to look good, in a few months is tough. So is passing up spending on some bauble so that you can live the life of your dreams a few years down the road.
Alex, correct me if I'm wrong, but it's something I'm just thinking about as you're speaking. I feel like it's often said it's right now is the time, and it's never been easier to create your own business. And I'm almost feeling like right now it's never been easier to really build wealth, just given the direction that we're heading in. Now, something interesting we were talking about even before we jumped on is the next 4 years. I mean, under this new administration, you have shared, and we were just discussing this, there could be a potential where America can see another 20 million plus millionaires being created. And I'm assuming this is all because of AI and kind of just tech in the future. But can you talk to us a little bit about that?
Yeah, I'm glad you brought that up, Ari. It's a great point. We are living in a golden age for investors. I'll talk partly about why that's happening, and then I'll sort of segue into what Trump has to do with his administration and his policies. I talk to people who say the little guy doesn't have a chance in this country. When it comes to investing, they could not be wronger. And I wonder if they've even looked into the situation. First of all, most investment mutual funds and even brokerage accounts don't even have minimums anymore. It used to be you can't meet our $10,000, $25,000 minimum. I'm sorry, so you couldn't even get started. Or if you did, there was huge fees attached. Well, now you have commission-free stock trading, you have no-load mutual funds, you have no-load index funds where the expenses are like 0.02% a year, which is practically nothing. The spreads between bid and the ask on stocks have never been lower. Executions have never been faster. I mean, I used to be in the brokerage business, and someone would call me up on the phone and ask for a quote, and then I would put him on hold and run down the hallway and take his ticket into trading, and 10 minutes later give him an execution. Now you see instantaneous execution. You can monitor your portfolio in real time. I mean, it's never been easier to build wealth than right now. The part about the Trump administration I'm really excited about, and I don't care what your political persuasion is, maybe you love Trump, maybe you hate him, it doesn't matter. What you need to understand is that Trump is a businessman, and like Calvin Coolidge, who was president a century ago, Trump knows that the business of America is business, and he wants to help people create businesses, expand businesses, and invest and become financially independent. So there are a number of policies that we could talk about that he's in favor of that I think are going to be good for the economy, good for wages, and good for corporate profits and the stock market.
So in terms of these policies, and just in terms of even Trump himself, like where should we as investors be looking? And I feel like, of course, just looking back at like past decades, the Coca-Colas of the world are almost out. And we almost have now today the NVIDIAs, the Microsofts, the Googles, and just AI and a quantum focus. Is that really where we should be looking?
Well, just like the internet changed everything, it was hard in the early days when you had a dial-up modem and it took, forever for a page to load on the internet. It was hard to imagine how the internet would change everything. Artificial intelligence is going to change everything. We're still in the top of the first inning. I don't think it's really fully apparent to people. I mean, I'm on AI all day. I use every platform. I use primarily Perplexity.ai, but also ChatGPT and Claude and Copilot and other platforms, and it's amazing what you can do, and the cost savings for business are going to be enormous. So I do think there's a technological revolution taking place, and look at what's happened with everything tech related. I bought one of the very first flat panel large screen TVs, and it was probably 20 years ago, and it cost me, this is going to seem astonishing to your younger viewers, but I had to have it because I saw it in the store and I said, that's the most amazing thing I've ever seen. I paid over $10,000 for it. And that was because I bought it. It was actually $12,000 in Best Buy, but I was able to buy it online for $10,200. And now, of course, you can walk in Walmart and get one for $250. And so just like the phones have become, smartphones have become cheaper, computers have become cheaper, television sets have become cheaper, technology has a disinflationary effect. And it also is a wildly productive effect. And productivity is really just about doing more with less. And we're actually seeing a productivity boom, something that preceded Trump coming into office, where productivity is increasing, and that allows more output per hour of work by our employees. And it's very beneficial. It's good for corporate profits, and anything that takes corporate profits higher takes corporate share prices higher. And so as an investor, and everyone watching should be an investor. I mean, if you're just a consumer, it's not enough. If you're just a saver who earns a very low rate of interest, it's not enough. You have to work, save, invest smartly, and then compound that money. But I do think that a lot of what Trump's got coming up in the weeks and months ahead is going to be very positive for the stock market, and so for investors generally.
Now, should we be scared at all with news out of China? I mean, it seems like China is becoming very competitive with AI. Even just today, news came out of China, and it looks like NVIDIA plummeted. Should we be scared about that, or is really the American dream the American dream?
Well, there are two separate things. First of all, I was shocked that China, which does not have as powerful chips, is apparently running AI that is just about as good as some of our most advanced models. I don't know if they're going to be able to maintain that edge without the most cutting edge chips, because AI is very power intensive. And also, I'll also note that Chinese AI, if you ask the most basic question about China's president or the Communist Party, you get a nothing answer. So already you have censorship that you don't have in the U.S. And then there could be issues just like we've had with TikTok. What is China doing with the AI questions you're asking? It's another issue. So I think this is going to be a short-lived thing. I do think that anything that makes AI less expensive, I mean, it's already essentially free for most people. You can pay for upgraded versions, but I do think that the Chinese competition is going to be short-lived here, and that they just don't have the freedoms or the capital inflows or, quite frankly, the lack of government controls that will make U.S. and European and Japanese AI superior over the longer term.
So let's talk about where exactly we should look. Like, are we focused on the Mag 7? Should we be going with maybe, an ETF, kind of like Vanguard's Tech ETF, VGT? Where would you recommend we even look?
Well, the companies that make up the Mag 7, which I think everybody knows, it's Apple, Amazon, Alphabet, NVIDIA, Tesla, Microsoft. Those companies are great companies, and they are so dominant. I think they're going to be around for a long time. Jeff Bezos says that he knows that someone will eventually replace Amazon with something better, but it's hard to imagine that happening anytime soon. They've got such a commanding lead in what they do, and so do the other 6 of the Magnificent 7. However, I do think that people are, and I've been saying this for many months now, they're making a mistake to believe that, for instance, NVIDIA can continue to do in the future what it's done in the past. Like, it's up something like 7-fold in the last 5 years. But remember, for a $3 trillion company to rise 7-fold, it would have to be worth $21 trillion. And there's never even been a $4 trillion company. And I'm sure there will be a 4 and 5 and on up. But only Apple and Nvidia have a market cap that's in the $3 trillion range. And it's so people are looking at past performance and then making the classic mistake of thinking it's going to continue. And I do believe that NVIDIA, which is a great company and makes the chips that makes the generative AI possible, is going to give decent returns going forward. But when I say decent, I mean 10, 15, 20% a year compounded. That's a great return, but to rise several fold like it has in the last few years is a virtual impossibility. And so I think people make a mistake to just chase trailing performance. I actually came up with a list of what I call the next Magnificent Seven, which is 7 smaller tech stocks. When I say smaller, I mean they might be worth billions of dollars or maybe in a few hundreds of billions of dollars, but they're not the Goliaths that these companies are. And I think that if you think back to what the great one Wayne Gretzky said, that what he did was he didn't skate to where puck was, he skated to where it was going to be. And that's a great lesson for investors. You don't want to chase where the puck was. You want to skate to where the puck is going to be. And I think a few years from now, you're going to see other tech-related companies that give the kind of returns that these Magnificent Seven have given over the last few years. So don't just chase trailing performance. Look at what would be the great performers of the near future.
Now, when it comes to the past performance, though, in and of itself, I mean, a lot of people will naturally do that. Just look at the past performance and say, you know what, I'm going to put all my chips onto, even the big players because of that past performance. But let's talk about some of these smaller players that we are probably overlooking right now. What type of value can they deliver for us? And are they more riskier bets that we should be cautious of? Or are they just as safe, but we're being, a little bit more cautious and straying away because they are, smaller caps or just not in the big picture for us?
Well, they're not riskier. What I think, there's risk in buying the Mag 7 and there's risk in buying what I think are the next Mag 7 or other tech-related stocks. The key is they have much more room to grow. Remember, if you're a $2 trillion company, to get to $4 trillion is pretty tough. If you're a $100 billion company, to get to 200 billion or 500 billion is not that hard. So it's just a matter of scale. It's much harder to grow significantly when you've got a market cap that big. And it's not a knock against NVIDIA or its business model. It's younger companies, which, by the way, small cap and even mid cap stocks have underperformed large caps by a wide margin over the last few years. But you can look back through history and see that we go through consistent cycles where growth outperforms value, and then cycles where value outperforms growth. Large cap stocks outperform small caps, and then sometimes small caps outperform large caps. And sometimes foreign stocks outperform domestic stocks, although that hasn't happened over the last 15 years and by a wide margin. So again, I really believe that if you want to outperform, if you just want to get a decent return, you can buy an S&P 500 index fund, and you will get a decent return. You won't outperform because by definition, you'll get the market's return. But if you want to do something where you outperform, you have to do something that's a little bit idiosyncratic. You have to do something that most people aren't thinking about. And I think that there's lots of areas of the markets, not just in tech, but in oil and gas and retailing and elsewhere that have a ton of potential. But I do want to get back to the fact that I think that Trump is bringing about some policies that are going to be very positive for business generally and for all sectors of the market. Let me just talk about a couple of those things. One is the tax cuts. He wants to extend the 2017 tax cuts that he implemented in his first term. And what does that do? It gives businesses and consumers more money to spend. And if you're a business, you can expand, you can do more R&D, you can do more hiring, you can raise wages, you can invest more in technology, and all those things are good for increasing sales and profits. He also is a businessman in that he knows that red tape hamstrings businesses. They spend a ton on compliance. They're always afraid of being sued for violating some obscure regulation they didn't even know about. And so by deregulating and cutting the number and when I say deregulating, I'm not talking about ending regulations. Nobody wants to see the factory dumping their waste in the river out back. That's not going to happen. We're talking about meaningless regulations and add to the cost of production, add to the cost that consumers pay, and getting rid of those will bring down costs and make it easier for businesses to do things. And look at California. They have all these restrictions against building, and then they have the fires in LA, and they say, well, we're gonna do away with all those restrictions. Well, if you can do away with it after a fire, you can do it without it when there is no fire. And so I think Trump's deregulation is going to be very positive. Another thing that I really like is that Biden, and especially Lita Khan at the FTC, was very tough on mergers and acquisitions, looking at, if a company became big, it was clearly doing something wrong and needed to, closer examination, and tried to block mergers and acquisitions. And this is such a mistake, because the only way that a small company gets bigger is that it starts pleasing more people, makes more raving fans of its customers. Everybody loves small business, but what is it that if a small business becomes big, it's all of a sudden what they're doing is wrong? And the idea that you can get bigger and you can grow by acquiring someone else in your industry, and that's bad, is wrong. And the Trump administration realizes this. So that's yet another way that we're going to see a booming economy and stock market under the policy. Now, I'm not saying that there couldn't be some bolt out of the blue if China makes a grab for Taiwan or things blow up in the Middle East. You could have a different scenario. But given the scenario we've got now, if we have these tax cuts, these deregulations, this more lenient view toward mergers and acquisitions, and opportunity zones and other things that Trump is talking about, it'll be a positive. And if he passes his tariffs, and it certainly looks like he's going to, I shouldn't say pass, he's going to do executive orders for tariffs, that will also promote U.S. businesses. I'm not a big tariff fan, because it tends to invite retaliatory action overseas. We put tariffs on one country, so they put tariffs on our exports, and it can be a negative. But if it's used as a negotiating tool, I'm going to put this tariff on you unless you bring down your tariffs on us, then it can be positive. And under any circumstances, a tariff is good for domestic businesses, which tend to be smaller and mid-cap companies. Large caps are the ones that are multinationals that are more affected by tariffs. So it's yet another reason to gravitate toward the smaller stocks right now.
Alex, are we at all worried about, for example, the market mandates over the last few years really have been inflation and interest rates? Now with Trump coming in this new term, 4-year term ahead of us, are we still worried about interest rates or inflation, or not so much?
Well, coming into 2025, it looked like the Fed was going to cut rates 3 or even 4 times. Now the rate cuts are pretty much off the table, because inflation has proved to be sticky at around 3%. But here's what I think is the good news, Ari. The inflation that we saw during the Biden term was due to 3 things. One was the supply gum up that we had because of the COVID pandemic. And when you shut everything down, of course, demand doesn't shut down, just supply does. And so the supply chain globally got all screwed up, and that raised prices. Then the Federal Reserve kept interest rates at 0, and even said publicly they were going to let inflation run hot for a little while in order to make sure the economy was still growing just through the pandemic. And that, of course, we look back and see they kept interest rates too low for too long, and then they had to raise them dramatically. And then, of course, we had the multi-trillion-dollar Biden administration's blowout spending, where they thought a crisis was a terrible thing to waste, and spent like drunken sailors on everything. And those 3 things are all behind us. The Biden administration is behind us. The 0 interest rates are behind us. The supply chain is back to normal. So I think inflation is going to stay relatively low. Whether it gets down to the 2% target that the Federal Reserve would like to see, I don't know. But I do think that there's no reason to think that prices are going to spike anytime soon, because the factors that caused the highest inflation in 40 years are in the rearview mirror now.
So let's talk really quickly just about, the dividend investors who are out there, the value-oriented investors, the investors who tend to stray more away from growth. What should we expect now in the 4 years to come? Because really, it seems like a lot of the opportunity, the golden opportunity, really is in tech and in growth. Is it going to be a giant mistake for a lot of those value-oriented dividend investors to be invested where they are?
No, just the opposite. I think that what most people need to do is hedge their bets. You want to own growth, yes. But all these people who are plowing everything into growth stocks and the Mag 7 and thinking that that's just the place to be and always will be the place to be are making a mistake, and we don't know exactly when it will happen that value will once again outperform growth, but it will happen. And if you have nothing in that sector, you find out that I should really say asset class rather than sector. If you don't have anything in that asset class, you end up playing catch up. After there's been all of a sudden value stocks are up 50%, you go, oh, I don't have any value in my portfolio. So you want to asset allocate, you want to have large caps and small caps, you want to have growth stocks and value stocks, dividend payers and non-dividend payers. And I realize that a lot of stocks make their biggest move before they even pay a dividend, or oftentimes before they're even profitable. If you look at Amazon and Tesla and Netflix, what their share prices did before they ever earned their first dime, it's pretty astonishing. And if you're not earning anything, you're not paying any dividends out. However, there's a lot less downside risk in dividend paying stocks because, number one, that dividend supports the share price when things get tough. And it also shows that the company does have a good cash flow and profitability where they couldn't be paying that dividend out. So again, I'm not saying that growth stocks are not going to continue to do well in the months ahead. I think they probably will, but value stocks are so cheap. Small caps and mid caps are so cheap relative to these large cap growth stocks that I think people are making a mistake to just think that history is going to endlessly repeat itself, that we're going to see large cap tech stocks outperform everything else forever. It's not likely, especially because, like, take Apple. Apple is the single largest position in my portfolio. I've owned it not just for years, but for decades. I've seen all kinds of cycles up and down. But Apple at 35 or 40 times earnings, I mean, for such a big company that's not growing anywhere near that rate, it's hard to see that the stock's going to be a big performer in the immediate months ahead, even if it does well over the next 5 or 10 years, which I think it will, or I wouldn't still be owning it. But are there things that are going to perform better over the next few years or even the next few months? I think there are, and that's really where investors should be looking now.
And as for retirees, next 1 year, 2 years, 3 years out, are we in a safe spot in terms of those who are coming up to retirement? Should they stay focused on, going more towards the value and dividends, or should they get their hands on some growth just because of the economic landscape and the term that we have ahead of us?
Well, that's a good question, Ari. Is if you're retired, how does the outlook? I mean, the outlook looks good, but remember, lots of crazy things happen that just completely come like a bolt out of the blue. I mean, I was a stockbroker when the stock market crashed in '87. I'll never remember that Monday morning. I came in. Nobody got shot, no currency failed, no government collapsed, and yet the market gapped down at the opening and didn't stop falling until it had dropped 25%. And people still look back, and other than program trading, they wonder what caused the stock market to crash that day. Then we had Saddam Hussein going into Kuwait in 1990, that caused a bear market, and we had the dot-com collapse. Of course, no one predicted the dot-com bubble before it happened, and so the crash came as a surprise. And then we had 9/11, and then we had the financial crisis, the housing bubble and the financial crisis, and then we had the pandemic. And you look back and you go, well, who was predicting the pandemic, and who was predicting 9/11, and who was predicting all these things? No one was. So that's why you asset allocate. You have some money in stocks, but you also have some money in bonds. If the market sells off dramatically, you can take some of that money in bonds and put it into stocks. And if the market does poorly, you also have bonds that hold up your portfolio before things drop. But I think the outlook is very positive. That's one of the reasons why I'm writing this book about the American dream. I think that it's easy to get caught up in the negative talk of the media. The media has an agenda. The media's job is to unite you with their advertisers. That their advertisers want eyeballs and ears and likes and shares and retweets and whatever. And so they know that human beings are hardwired. So it's part of our evolutionary history to be constantly on the alert for bad news. If there's smoke on the horizon, if there's a rustle in the grass, your ears perk up and you realize that you might need to do something. And they constantly bombard us with negative information. Every day it's about war and terrorism and crime and corruption and environmental degradation and inequality and all these terrible things. But the positive things that are happening, and there are a lot of positive things happening that don't get reported, in part because they are positive. What's newsworthy is the deviation from the norm. For instance, the New York Times could have run the headline that 30,000 people escaped extreme poverty every day for the last 30 years, but it never ran that headline because 30,000 people leaving extreme poverty is not news. But over a period of years and decades, we've had billions of people who've left extreme poverty, and lots of other positive things have happened. I mean, people are living longer than ever, standards of living have never been higher, educational attainment's never been greater. All forms of pollution, with the exception of greenhouse gases, are in decline. And in the U.S. and Europe, even carbon emissions are declining. So there are lots of positive things happening that you want to capitalize on, but you have to be aware of them, and you have to be an optimist that these trend lines are going to continue. That's why I often tell investors, follow the trend lines, not the headlines, because as the old saying goes, the trend is your friend. And there's a lot of positive things happening out there. And I do think that with the new Trump administration, we're going to see a restoration of the American dream. And I recently held a summit with Bill O'Reilly, who's a long-term subscriber of mine. He's also, in addition to the guy who runs the No Spin News on his website, is the best-selling nonfiction author worldwide of all time. All his Killing books and others have been bestsellers. And he and I held a conference recently where we talked about some of these factors that are likely to drive the economy and share prices higher and allow people to live their version of the American dream.
So my last question for you, Alex, because 20 million new millionaires is a pretty bold number, right? But obviously we all want a slice of that. We all want to become the next millionaire, at least in that pie. What's the catch here? How do we actually go about becoming a millionaire, and that 20 million new millionaire status is for the next 4 years or beyond?
Okay. The first thing, that's a great question, Ari, and the first thing I want to say, and this is the point of my whole book, the American dream is not an entitlement that you collect at a government office. It's an aspiration that you have to work towards. So the first thing is knowing what it is you're trying to accomplish. Okay, you're trying to reach financial independence. That number will vary depending on your chosen lifestyle, and also obviously it's going to be tougher for a truck driver than a brain surgeon to reach financial independence, but the principles are the same. And I've always said that if you haven't reached financial independence by the time you retire, one of these things is true. You didn't work. Some people are unable to work because of physical or psychological handicaps, but you either didn't work, or you worked but you didn't save, you spent everything, or you saved but you didn't invest, so you didn't earn a high rate of return, or you invested, but you didn't do it wisely, so you blew up your portfolio in the market, or you invested wisely, but you didn't let the money compound. You had to spend it. You had to have that new boat or redo the kitchen every 6 years or whatever. Because if you do work, and if you do save, and if you do invest, and you compound your money, you will achieve the American dream. And it doesn't take that much. A few $100s a month, compounding regularly, even if you did no better than the S&P 500, which has delivered a long-term annual compounded return of about 10% with dividends reinvested, will make you a millionaire within a period of 20 or 30 years, depending on how much you set aside. But if you don't work, if you don't save, if you don't invest, then it's true. The American dream is just a pipe dream. It's not going to happen. So it's up to the individual. I told my own kids, when they were teenagers, Dad, can I stay out later? I go, you know what? Think of the freedom to do that as a coin. On one side, you have freedom. On the other side, you have responsibility. If you're not going to be responsible, you're not going to get the freedom. If you want to be a financially free person, you are going to have to take responsibility for your life, for your own welfare, and do what you have to do. And it means making some hard decisions. Maybe you need to increase your income, work some overtime, work some weekends, even take a second job. Maybe your spouse needs to work. Maybe you need to live in a smaller house. Maybe you need to drive your car longer rather than getting a new one every 3 years. Maybe you need to eat out less often. But maybe you can save for these things separately and still not raid your retirement account. But the main thing is to have a goal, have a plan to get there, because the principles of wealth creation are well understood, they're well known, but that doesn't mean they're known by most Americans. And the ones who don't know these things are suffering because they think, where do I collect my American dream? It's not something you collect, it's something you earn. And that's why I'm writing this book, and that's why I had that recent summit with Bill O'Reilly, to help show people the principles that they need to follow in order to achieve the American dream.
And investors, I got to say, it's that simple. The American dream is still alive. Alex has a link that is down there in my description, in my pinned comment, so definitely give that a click. Alex, we will have to have you back on when the book officially drops, and definitely send me over the link so I can send that out to everybody out there. But it's always a pleasure to have you on. Always catch new insights and learn a lot from you, Alex. So I'm looking forward to the next time you're on with us.
Well, Ari, I love being here. The book will be out probably in the fourth quarter this year, and I'd love to come back and talk about it some more.
Absolutely. And investors, until the next go round of Masters, we will catch you all there.